Next, we'll take a look at what is standard costing. Standard costing is concerned with the control of expenses and hence more internal in nature. Simply put, it is the projection of cost accounts that are or that was dealt in previous lectures actually. Now, what is variance analysis? That's what we'll take a look at. The variance analysis is a measurement of actual deviance from the expected and actual performance, forms the intended performance, and it also forms the basics of variance analysis. Based on the principle of management by exception, this method draws the attention of management to variations in monetary gains and reports the responsibility chain and causes for such a gain actually. Variance may be controllable as and when there is excess usage, as in usage of materials or time taken by a worker to complete tasks, as opposed to uncontrollable, as in the case of governmental restrictions or the wage rate hike in response to a strike. Variance also may be because of differences that management perceives in terms of cost control measures and are material variance, labor variance and overhead variance. So variance may be belonging to one of this: material variance, labor variance or overhead variance. Material variance may be material cost variance, which is the product of difference in standard cost of direct materials and actual cost of direct materials. It may also be material usage variance, which may be the difference between standard quantity as opposed to actual quantity of materials used. Material mix variance is when two or more materials are used to produce products, with the difference between standard and actual composition of materials contributing to this type of material variance. Now, what is labor variance? Labor variance arises because of differences in actual rates and standard rate of labor, as well as in the variation felt as a difference between actual time taken by workers against standard time taken to complete jobs or tasks which are assigned to them. So that is labor variance. Lastly, what is overhead variance? Overhead variance may be the difference between recovered overheads and actual overheads. Overhead, as we may recollect, is a term used to indicate indirect material, indirect labor and indirect expenses, where the variance is felt is directly to factory, office, selling and distribution networks, etc. So this completes variance.